The Insurance Pro Blog Podcast, episode number 104. Skip whole life insurance, invest directly, and make less money? Hello and welcome. This is the Insurance Pro Blog Podcast. It is Thursday, April 4th, 2018. This is episode 104. I am Brandon Roberts.
And I am Brantley Whitley. Today's April 4th, but I think this show will actually come out on April 5th.
Oh, you're right. Today is April 4th. I wrote that's now we're giving away the secret of the Insurance Pro Blog Podcast.
Oh, I'm sure everyone thinks we do it live on Thursday.
This is why every time you hear this podcast come out over the airwaves like that, if there's something breaking news that happened late on Wednesday, we don't talk about it.
Big secret. Big secret.
Hey, I will say this is a lot better than back in the day when we used to record it on like Friday or Thursday and release it on like the Wednesday of the following week.
Better in what way?
I mean, if there was something,
you mean just
happened,
closer?
We have a little more opportunity to
to
bring it up.
I guess so. Well, considering that was more of a current event sort of thing, and this one is not, it probably wouldn't matter as much. It did give us more time to write more. That was kind of the trade-off. But
it did.
Anyway, I guess nobody wants to hear us talk about our production. That's for sure. So, what are we talking about today?
We're talking about how the scam that has been perpetuated by the life insurance industry for over 100 years to sucker you out of the gains that you could be making if you just skipped life insurance and bought the investments that they put their money in yourself.
Oh yeah. That is it's a big conspiracy.
It is. It's almost Bernie Madoff like a ruse. No, there are
sure
times that people will come and they will, people have asked us this question. There are those who have written articles and blogs that have suggested, when you give an insurance company money, all they're doing is taking your money and investing it in the things you could invest in yourself.
Right.
So you can pay all those fees to the insurance company if you want to, but you could skip all that by simply investing your cash in those things that they're going to buy yourself. And then you can not pay those fees. Don't pay the middleman.
Yeah.
Just like you could put your house on the market all by yourself.
Absolutely.
And leave it there for a couple of years and make way less money. Your choice.
You could do that in Vermont. You could sell it.
This joke brought to you by the National Association of Realtors.
We should get them to sponsor. In Vermont, you could sell it yourself, and you could sell it in 5 years instead of 2.5.
Yeah.
So, yeah, that's true. So, are you contending that it's not the same? You can't just go out?
I'm just gonna suggest. We're gonna hit the punchline early today.
Uh-oh.
I'm just gonna suggest that maybe, just maybe, it's a little more complicated to invest in those securities yourself than some of those people have led you to believe.
Yeah. I would agree with you. And let's
break it down, shall we?
There's a slight delay in Skype today, obviously, because I keep we're talking over each other.
Oh, okay.
So
okay.
I just have to apologize to the people who are listening. So
that's okay. Let's kind of break this down for a second, and we'll even we'll back up and roll the argument out as it traditionally is presented.
Mm-hmm.
So 85 to 90% or more of the general account at most insurance companies is comprised of bonds.
Right.
So the argument is you just go buy the bond yourself.
Right.
Now, if only we were in a big room of people and I could ask everybody in the room to raise their hand if they've ever personally bought directly a bond in their life.
Not a bond fund.
Yep. Not a bond fund. The actual bond.
Right.
This point would have a whole lot more firepower behind it. But
Right.
I'll just ask the general listeners to ask themselves.
Right.
How many bonds? I'm not talking about U.S. savings bonds. I'm talking about corporate debt.
Right.
Have you gone out and purchased directly yourself?
Absolutely.
It's not.
It'd be a small number of people.
It's rare to run into people who do that.
Well, the first question you could ask them is, do you know what a CUSIP number is? If you don't know what a CUSIP number is, then you've not ever bought a bond.
Right.
Because that's and a CUSIP, stocks have them as well, I believe, if memory serves. But every security that's traded has one, basically.
Yeah.
And it's a unique identifier. And they do that with bonds in particular. It's very important because bond issues, one company may have definitely have multiple issuings of bonds. So to identify the particular bond that you would like to purchase, you must have the CUSIP number. Yep. And most discount brokerages, I believe you can purchase them. It's not an online transaction. It's, you got to call in and talk to a broker.
Yeah, it's not going to be the thing you get $7 a trade for.
No, not usually. That'd be a sweet deal if you could, but
it would absolutely be a sweet deal. But as you and I know,
there's a markup in bonds.
Absolutely, and that markup is kind of up to what the
market will bear.
Yep.
That's what it is, really. And that's not disclosed or required to be disclosed.
Nope. So when you purchase a bond, an actual bond, what you pay, you don't necessarily know how inflated that price is over what the person who's trying to unload the bond paid.
I can tell you when you'll find out. You want to know when you'll find out?
Sure.
A few days later, when the trade settles and the value of your bond is less than what you paid for it, that's when you'll know. I mean, because bonds have a market price, so it will fluctuate. The par value, the value of the bond, the market value of the bond will fluctuate. So you'll find out that you paid, 1.5 or 2 in markup when the trade settles.
I feel like this point could be a little cryptic, so I want to make an analogy,
probably.
But I want to ask you to verify my analogy for its soundness.
Okay.
So imagine, if you will, you go out looking to buy a house, and the price that you get told you need to pay in order to buy the house is $305,000.
Right.
And you don't have the process of what are the people coming to determine the value? An appraiser. There we go.
Appraiser.
You don't have that luxury. That's not going to happen. Like, you're just going to pay with cash.
Okay.
And 305 is kind of the price that you've been told is what you got to pay.
Right.
So you do that, and then a day or a week later, you discover that actually the house is 275.
Right.
It was just marked up to 305.
Right. Exactly. That's kind of how it works.
Mm-hmm.
Or you could even look at it this way and go, well, it was actually worth 305 and you bought it for 305, and you decide you don't like it after 6 months and you want to turn around and sell it, and it's still worth 305. Well, now you're going to pay a realtor, so you're not going to net 305.
Yeah.
So that happens in bonds as well. I mean, it's just and I'm not maligning the bond industry. This is just the way it works.
No, bonds can be a wonderful place to invest. It's just it's not a beginner's game.
Not usually, no.
And it's not even for the people who fancy themselves as advanced investors because they read Barron's or something like that. It's
wow, you pulled that one out of the archives.
It's
Barron's.
There are many people who live their entire lives investing in the stock market, mutual funds,
right,
who will never touch bonds because they never have the sophistication or even the money to do it.
Right. That's true to some extent. Yep.
So the pivot, obviously, for the CFPs is to say, well, you just buy bond funds.
ETFs or
'Cause
funds or whatever.
That's how you get the bonds. You buy
Right.
bond funds.
That's what I've seen over the years. 99% of the time, that's how it's done.
Yeah, absolutely. Exposure for most Americans to bonds as an investment is through ETFs or mutual funds.
Yes, absolutely.
There's just one tiny problem with that.
It's the worst way to buy them.
ETF and mutual funds do not function at all like
Like
investing
bonds.
directly into bonds.
No, they really do. Yeah, that's a great way to say that, because I mean, it's absolutely true. You're not buying what you think you're buying usually.
Mhm.
The diversification models, their asset allocation models, I guess I'm supposed to call them, say, well, you should have 30% of your money in fixed income.
Right.
Great. And so people go out and they buy I don't even know what's the hottest thing of the day. Probably the Vanguard Total Bond Market Index Fund or something. I don't know. I don't know if something like that exists, but probably.
Yeah.
That's how they get exposure to it.
Right. Actually, that's like how the super savvy get exposure to it.
Right.
For most people, it's whatever fund company they set their IRA at after
Yeah.
they rolled over their 401k,
Yeah.
their fund. That's what they end up in.
Right. Or maybe a few of their funds if they're
Yeah.
super sophisticated. Okay.
The problem with that approach, though, is if you are investing directly in bonds,
Mhm.
usually you're doing it to create income. And I
Right.
don't mean that as income to pay the bills or the groceries or something like that. You're doing it to create a yield
Right.
that is supposed to accomplish other goals within your overall portfolio.
Sure.
Most Americans,
Including just allowing so it depends on what kind of bonds you buy, but let's just assume that most bonds pay you twice a year.
Yeah.
So you get a coupon once every 6 months.
Yep.
Yep. I mean, even if you're just allowing those coupon payments to accumulate as cash, that's a strategy. I mean, that's a risk aversion strategy, I suppose.
or for some investors, very savvy and sophisticated investors, there is a strategy to actually to cause capital gains in those bonds.
Sure, absolutely.
You believe the yield is high.
Yep.
You believe interest rates are going to dip,
Right.
and that is going to make the bond that you purchase worth more money.
Or maybe the company just had some bad announcement that caused the prices of their bonds to fall, but you're looking at what you think is their ability to actually repay the debt, because that's what a bond is.
Yep.
And you're going, these are way underpriced. This is a sweet deal.
The yield is going to be phenomenal.
Right. In the meantime, the yield will be great and it'll probably appreciate. So
And here's the great thing about buying bonds. Unless the issuer pays the debt off early, which almost never happens.
just depends. Yeah, it just depends.
If an announcement gets made that drops the price of some companies issuing debt, and you look at it and go, that's going to be a great discount, I'm going to get a great yield, you buy it. Whatever happens to interest rates after that, or the bond price of that, or the price of that bond after that, doesn't matter to you.
Not really, no. If
Because
all
you're
you
still
want to
gonna
do is
the
collect
yield that you were set up for.
If you just want to collect coupon payments, then yeah. Not really a big issue for you.
Now, the translation to bond funds is that none of that's true.
Right.
And unfortunately, bonds really are a way to secure a certain amount of additional yield or income for other purposes.
Right.
But we have this just totally warped idea as general investors and even most investment advisors to basically tell people, bonds are just a safer place to put your money.
Right.
Less volatility.
Until there is.
Yeah. And that's the problem. Like you're not really investing in bonds to just be safer.
Right.
In many respects, they're not. especially when you're talking about a lot of corporate bonds, especially if they're not super highly rated, and you have a condition like right now where interest rates are rather low, and there is an ever-present possibility that they creep higher.
Yeah.
And we don't need a massive jump. Like there's been a discussion for many, many years that, oh, well, there could just be this pop in interest rates. There could be. But it's just not super likely to take place.
Sure.
Now, a gradual rise, absolutely. And if that gradual rise takes place, there's going to be a gradual decline in bond par values.
Right.
And when that takes place, the value of bond funds is going to follow.
Sure. Yeah, because it's very simple. I mean, if if a bond fund bought a bond, let's call it, I'm just going to go back and say 5 years ago, and let's say it was a 20-year, I'll just call it a 20-year bond. So it was a new issue. I'm just going to assume perfect world scenario, and you paid $1,000 par value for the bond, and it has a coupon of 3% for a 20-year bond. That means twice a year it's going to pay you, and your yield each year will be 3% total. And it's going to continue to do that for 20 years. But we're now 5 years past, and now interest rates have risen. So the Fed has raised rates, which the Fed doesn't. There's a big misnomer there or misconception that the Fed controls interest rates. The Fed controls one
Money
tiny
supply.
component of interest rates, which are super short term. So, but typically speaking, long-term rates are affected as well. But long-term rates are controlled by market forces, not by the Fed. So now you can buy a new 20-year bond, but let's say it has a coupon of 3.5%. Well, why would anyone want to buy the bond that pays 3% from you for $1,000 that you paid for it when they can buy a new one at $1,000 that pays 3.5%?
Mm-hmm.
They won't. So what they'll do is they'll offer you some amount less than $1,000 to make it equal something closer to 3.5% that they're going to receive. So that's the risk that you have, and a bond fund has a huge pool of these things. So,
yep.
Hundreds, if not thousands of them, typically.
I'm going to say I am, but I think you're on board with this. I'm fundamentally of the opinion that anybody who tells you just invest in those things yourself, you can cut out the middleman, is giving you advice they have never themselves actually perpetuated.
Of course. Hey, I got a great analogy. It's just like all the so-called experts out there telling you can't get insured. Don't worry about it. Just buy the policy on your kids and use your kids as the
works real well.
It works really well, except that no insurance company wants to take $40,000 in premium on a 3-year-old. So,
yep.
And like, how many Huggies commercials have they been in? None. Well, sorry.
I give you a great personal firsthand, for instance.
Yep.
So a couple of years ago, I decided to take some money sitting in an index fund.
I'm laughing because I already know where the story goes.
And I wanted to move it to something that was basically cash-like, but for some reason, the particular fund company didn't have an option for me to do that in the way I wanted to. So I decided to go about this the way that insurance companies go about it. Right? I mean, this is kind of a stupid decision, but as luck would have it, kind of playing out, I did exactly what insurers are supposed to do.
Right.
And I just decided I'd put it all in a short-term bond fund.
Right.
Like we're talking 6-month duration.
Yeah, that's the average duration in the fund.
And yep. And I mean, we know that insurers use bonds like that all the time as cash-like equivalents because they're not locking the money up for very long. They get a little bit of yield on it, and they can do with it whatever they want.
Right.
So I did that a couple of years ago.
Mm-hmm.
And I should theoretically be sitting in a place where I've basically just had a somewhat decent yielding savings account for the past couple of years.
Better than a savings, a little better than a savings account.
Yeah. I mean, that would be what the insurance company would achieve. My actual results have been a loss of almost $1,000. So cut out the middleman and paying the insurance company. But
But you lost money.
it ain't working near as well as it's supposed to.
Right. Funny thing about those insurance company expenses too, had you died, they would actually pay the death benefit. But I mean, that's ain't nobody want that. So
yeah, I'm alive, so it didn't matter.
Right. So you bought a short-term bond fund.
Yep.
And it's lost $1,000.
Yep.
And that's with the dividend payments.
Uh-huh.
Which probably come monthly, right? On something like that, I believe. Most short-term funds, I believe, pay a monthly dividend, I believe. But
yeah. So I haven't experienced what I was promised.
Ooh, I have a question. I didn't even plan this, but you teed it up for me. You own quite a bit of whole life insurance.
I do.
How much have you lost over that same period of time?
None.
Okay.
I'm up quite a bit on that. That's gone well.
Yeah. Just curious. Even with all the nasty expenses?
I know it's crazy, isn't it? Then when you factor in the fact that I'm the agent on those policies, it gets even better.
The returns.
Not that I'm advocating people go out and get a license and sell themselves insurance.
Do not do that.
I make that statement without also mentioning to you the thousands of dollars in licensing fees I've paid over the same time period. So it's a little bit out there on whether or not that was actually a good move.
Including all the states that make you jump through crazy hoops to only have the person not buy a policy from you. Yep. So, I may have experienced that.
A time or 10.
A time or dozen.
Yeah.
When I look at my renewals, I go, have I ever done any business in that state?
I got $50 in renewals and I'm going to owe $250 for that license.
Exactly. How many clients do I have in South Dakota?
And I have a blog that says insurance agents can't do math.
Yep. So anyway, let's not digress.
Yes. So the thing that is fundamentally missed here is that insurance companies are institutional investors.
Yeah.
With a lot of money.
Yes.
And they can take advantage of that scale in a way that most of us will never even come close to accomplish.
Sure. I mean, just from a very high level, just realizing that they have access to deals that retail investors don't even have the opportunity to purchase. So
ignore some of the bigger names, right? Let's talk about some of the small companies out there, like $5 billion and less in assets managed.
Right.
Let me say that again.
Small.
$5 billion.
Right.
If you've got a couple $100 million of net worth, which is generally not all stuff you just invest,
right,
you are substantially in a minority.
Right.
The average 401k balance across all ages is like $100,000.
Yep.
So, all right, $5 billion versus your $60,000 401k. Who do you think gets a better deal on price? And these are the little guys.
Yes. These are the smallest among them.
Yep. Imagine what kind of deals you can broker when you've just got $5 billion to go out and buy new bonds with.
Yeah.
Because the overall general account's $60 billion. It doesn't work in that fashion. And believe you me, they ain't buying bond ETFs.
No. Not generally speaking.
And then outside of that, I mean, we've spent a lot of time talking about bonds because I think it was very critical to make the point that even something as seemingly boring as bonds is actually quite complex.
Right.
And if you think you can replicate that in the same way an institutional investor is, you're kidding yourself. there's a sliver of the general account that goes into some very exotic stuff.
Of course.
Stuff that you would never even dream of doing because you'd look at that, assess the risk, and go,
Yeah.
Private insurance companies,
private equity deals, they're not even listed.
Yeah.
Sort of.
Insurance companies jump into those. They don't jump in. They enter into those agreements.
Yeah.
Understanding that I might lose a couple $100 million doing this, but it's not the end of the world if that happens.
Right. But I could turn $2 million into a couple $100 million.
Yeah.
Which helps us be able to sustain our dividend or to whatever for any number of reasons they could do that.
Mm-hmm.
They can and do, I should say. The thing is that you have to understand. I think one of the bigger points that people miss, and this isn't minutia, this is more conceptual, but the insurance company is wrapping up those. If we just isolate it to the bond discussion, they're basically wrapping that up so that you don't have principal risk.
Yeah.
Which, I mean, I bought for my clients back when I was securities licensed, I bought and sold quite a few bonds, individual bonds.
Mm-hmm.
But I rarely did we have access to really good deals, and there was always principal risk.
Yeah.
And so I think people discount that. Maybe they don't quite understand it.
I think that's the biggest driver.
But you're not going to achieve the same result that an insurance company does. And let's not, we haven't touched on this because it's not really part of this episode, but if we're talking about whole life insurance in particular, your dividend is also supported by just sort of general profitability of running a life insurance company.
How exactly are you going to expose your investment portfolio to underwriting
profits? Yeah. You're not going to. Yeah, you're not going to as an individual. It's not the same. I'm not suggesting that people shouldn't buy individual bonds. I'm just saying I'm backing you up and saying it ain't the same thing.
No.
As buying life insurance.
Our point behind all of this is that the suggestion that you can cut the middleman out, the insurance company, and make all the money yourself is fundamentally lost.
Yeah.
And it's a recommendation made by people who have never even thought through the ramifications of attempting to do such a thing.
Well, I mean, even simple things like if you buy individual bonds, you can't compound your growth.
No.
There's no reinvesting.
No.
That's a combination interest and principal payment. So or interest payment, but they're not reinvesting it for you. So you have to do something with that cash.
Right.
So you're not going to, inside of a whole life policy, you're able to take advantage of compounding growth without a tax consequence to doing so. So it's another benefit.
There's a funny little troll to bring up. Taxes?
What are you talking about? Taxes? I just buy municipal bonds.
And general investment expenses? Oh yeah.
Yeah.
It all adds up. It's sort of like the people who say they hate paying retail. They'd rather just buy directly from manufacturers.
Right.
And it's one of those statements that sort of says, well, what do you suppose the cost of everything would be if the manufacturer had to bear the expense of marketing and delivering all those things to you themselves?
Right.
I think you'll find retail's got some pretty good details or
yes.
discounts behind it.
Absolutely. And not the least of which is that you have somebody to represent you when things go sideways.
Yeah.
I mean, you well know because of other things, because you buy direct from, this has nothing to do with life insurance, by the way. I should say that. But because you have to buy direct from manufacturers.
Yep.
In quantity, and you're buying widgets, and you well know, like, there's very little support.
Oh, they are not anywhere near as cute and cuddly as Amazon, Walmart, any of those places.
Their websites are not set up for clarity.
Customer service? No. No.
I mean, you better know what you want. And I think I remember you telling me a story about having to go to a location and like you had to hunt for someone to talk to. Cause like, and they're not all that happy to talk to you.
Nope.
Because guess what? They're not making huge margins. So they're like, you're on your own. Like we're selling you this thing to you at a low cost. So guess what you get the sacrifice for?
All of those things that make retail special and heartwarming and the like.
Yeah. I mean, look, it's the difference between if you've, I'm going to use extremes here, but it's Nordstrom versus Walmart.
Right.
You know, you go to Nordstrom, you go to the shoe department, you're going to have somebody on you. And they're not pushy and they're not this and that and the other, but they're very good at trying to help you find what you're looking for.
Yeah.
Well, of course, the shoes that I buy at Nordstrom are going to be $300 a pair versus I could go to Walmart and buy a pair for $19.95. Good luck trying to find someone at Walmart to help you out. That's
right.
I stopped the clerk in Walmart not that long ago to ask them a question, and they looked at me as if there was something wrong that I was talking to them.
Mm-hmm.
It was sort of a look of annoyance and aggravation.
Mm-hmm. Yep.
I got 3 minutes till my break. No, I'm getting off the subject, but the point being, there's a reason that life insurance, buying a whole life policy in particular, is not the same as buying bonds.
Right.
So, whenever we
and
see
there's
those,
just many things that come along with what whole life insurance does from cash accumulation, wealth accumulation, putting it in the kind of looking at it as part of the portfolio perspective, that you're not going to cut those expenses out by going direct yourself. You can't even go direct yourself most of the time.
right?
And the complexity of what you would try, what you are trying to undertake in that circumstance, it's massive.
Yes.
And it is such a world apart from just buying bond funds,
Yes.
because that's not how that functions.
Right.
So they are not the same. Cutting the middleman out is not easy. And
Well, I mean, to cut the middleman out, you're accepting that I'm going to now become an expert on bonds. Well,
yeah.
Good luck with that.
Right.
Any more than you're going to become an expert on life insurance.
And you don't get to start out with your $5,000 IRA with anywhere near enough bargaining power to...
How many bonds can I buy? One? Maybe?
Half a one? Half a one.
Right. And we don't sell halves.
Yeah.
So
don't kid yourself.
right. Okay.
All right. With that, I am Brandon Roberts.
And I'm Brantley Whitley.
And we will see you next week.